The closing bell rang 15 minutes ago on this Wednesday, July 15th, 2026 session. And we need to look at these closing prints immediately because the S&P 500 finished up 0.38% at 7,572.40.
Right. And you've got the NASDAQ gaining 0.62% to close at 26,269.23, while the Dow, it edged up 0.29% to land at 52,658.64.
Yeah, so on paper for this deep dive, it looks like a totally flawless, just a tranquil summer breakout. I mean, we're hovering just 0.5% below that June 2nd all-time high of 7,609.78.
It looks like a breakout, but the narrative under the hood is pure chop. If you're actively trading this tape, you are caught in a massive macro tug of war right now.
Exactly. You've got cooling domestic inflation data pulling us higher, but then boiling global geopolitical tensions are just violently yanking the other end of the rope.
Yeah, and we really have to dissect why the market drifted up today before we look at the internals, because, that momentum was entirely powered by the June wholesale inflation data.
Right, the PPI report. So producer price index came out and actually fell 0.3% month over month, which is, that's actual deflation on a monthly basis.
It is, yeah. And that drops the year-over-year rate down to 5.5%. So if you're looking at Fed Chair Kevin Warsh, this is a massive sigh of relief.
Oh, absolutely. It basically boxes the Fed in, right? It gives them all the breathing room they need.
Totally. And the bond market priced that pivot in immediately today. The probability of a July rate hike just imploded to 11%.
Right, which sent the 10-year Treasury yield sliding right down to 4.55%.
Exactly. And, usually cheaper borrowing costs mean equities just have a clear runway to run.
But, and this is the huge caveat you have to pay attention to, that runway only looks clear if you ignore the actual geopolitical risks forming right now.
Right, because that beautiful June deflation report, it was subsidized by cheap energy. And July is already a radically different pricing environment.
It really is. And, just to be perfectly clear for you listening, we're strictly analyzing the mechanics of how this impacts the tape. We're impartially reporting the institutional intel here without taking any political stance on the actual Middle East conflict.
Right, we're just looking at the supply chain shock.
Because
we have a second wave of U.S. strikes on Iran, and they reinstated the naval blockade near the Strait of Hormuz.
Which is a critical bottleneck. You choke that off and crude just reacts aggressively.
Yeah, and it is. WTI crude is spiking back toward $80 and Brent is nearing $85.
So that cheap June energy is completely gone. The bill is coming due. Even Warren Buffett came out today and explicitly warned that this current speculation is bordering on gambling.
Because the upside momentum has a strict ceiling when you mix rising crude with a market price for a perfect soft landing. And you can actually see that ceiling when you look at the internals going into the close.
Yeah, let's talk about the internals, because if you want to know if real money actually bought this closing print, you have to look for volume confirmation.
And we just didn't get it.
No, not at all. Total volume across U.S. exchanges was just 16.301 billion shares today.
Which is incredibly thin. It's tracking 20% below both the 20-day and 30-day averages?
Exactly 20% below. So we touched an intraday low of 7,526.95 on the S&P and then just drifted up into the close. But, it wasn't institutional accumulation. It was just a summer liquidity void.
Right. It's an illusion of strength. But, the most dangerous illusion hiding in plain sight today is the VIX.
Oh, man, the VIX is just baffling right now.
It looks practically sedated, right? It's just stuck in this nowhere zone near 16.1.
Yeah, and you look at 16.1, and the math just doesn't make sense. We just talked about naval blockades, crude at $85, Buffett sounding the alarm. How does a fear gauge sit at 16 in that environment?
Well, it only works because of this record volatility dispersion. The mega cap tech stocks, your platform giants, they are so heavily weighted that their lack of movement is acting like this massive anchor on the index VIX.
Right.
They're completely masking the absolute chaos tearing through the individual stocks beneath them.
It's like this bizarre game of tug of war. You've got this, 300-pound giant standing perfectly still in the middle of the rope, which is the index. But on the edges, you have individual stocks just violently yanking each other back and forth. The center doesn't move, but the edges are pure chaos.
That's exactly it. The gap between individual stock volatility and the index VIX has blown out to a record 34 points today.
Which is insane. That's a 127% surge since March.
Right. And the DSPX index, which actually measures that individual stock dispersion, that had a 6-year high today of 47%.
So the volatility is absolutely there. It's just shoved under the rug by megacaps.
Yeah.
And the institutional notes are flagging that market makers are in this amplifying gamma regime. So in thin summer liquidity, their force hedging actually accelerates these price swings instead of dampening them.
Exactly. In this gamma regime, one fresh headline about that naval blockade could instantly snap this low VIX illusion. Market makers would be forced to mechanically sell, and it would just overwhelm the bid in minutes.
Which really explains the violent sector rotation we saw today. I mean, market breadth held up, right? We had 259 S&P stocks advancing.
Yeah, structurally it was okay.
But under the hood, the capital was shifting so aggressively, the tech sector basically fractured in half.
It really did. You had this relentless rotation out of physical semiconductor and memory names. Real money was just dumping hardware exposure ahead of Taiwan Semiconductor's earnings report.
Because the risk-reward into that specific binary event was totally broken. I mean, look at the tape for these chip makers today. SK Hynix fell 10.7%.
Yeah.
SanDisk dropped 12.4%. And Western Digital shed 7.7%.
You just don't see double-digit institutional liquidation like that unless risk is being fundamentally repriced.
Yeah.
But, that money didn't just go to cash.
Right, it rotated. Where did it run to?
It ran straight into communication services, defensive tech, and financials. The market is aggressively bifurcating right now. Apple absorbed a ton of that fleeing capital, pushing it up 4%.
And financials caught a huge bid, too. BlackRock surged 6.6% on that blowout earnings print.
Exactly. The platform giants are being treated as unshakable safe havens, while the physical hardware is getting actively liquidated.
And it's not just hardware getting a reality check. The speculative high flyers are just cracking. Look at SpaceX.
Oh, yeah.
I mean, they had their historic IPO in June, priced at $135 a share, the retail darling of the entire summer. And today, it actually slipped below its offering price to close at $133.59.
Which is wild. When the biggest IPO of the year breaks its issue price, while the S&P is, fractions away from all-time highs, that proves you are in a ruthless stock picker's market.
Passive index buying is just masking the pain in these high beta individual names. You can't just blindly buy the dip anymore.
No, you can't.
And to really understand how treacherous this tape is, we need to look at 4 specific single stock reversals from today that totally flipped intraday. Let's start with ASML because this one genuinely baffles me.
It's a classic case of valuation exhaustion.
Right, because they reported a massive Q2 beat, 9.3 billion euros in net sales. They raised their AI outlook. The stock opened up 7% at the bell.
Yeah.
And then it just faded all day to close only up 3%. Why?
Because institutional money refuses to overpay for trailing good news right now. The fundamentals for ASML are undeniably elite, obviously.
Obviously, yeah.
But at their current multiples, absolute perfection is already baked into the price. When it gapped up 7%, algorithmic players didn't see a breakout. They saw a liquidity event to dump shares into retail buyers and take profits.
Wow. So they literally used the morning gap up as an exit door.
Exactly. It was a textbook fade.
Okay, well, Elevance Health, ticker ELV, shows something even more punishing. This is what happens when institutions catch you dressing up the numbers.
Oh, this chart was brutal today. A masterclass in reading the footnotes.
Because the headline numbers look phenomenal. Adjusted EPS of $7.45 against a $6 to 21 expectation. They even raised full-year guidance.
Right. On the surface, it's a blowout.
But the stock absolutely plummeted 10.58% to close at $381.62. Walk us through what the smart money saw in that report.
It all came down to the supplemental data. When analysts dug in, they found that 80 cents of that EPS beat was from non-recurring, below-the-line investment benefits.
So it was basically a one-off accounting maneuver.
Exactly. It had nothing to do with their core healthcare operations. And once you strip out that 80-cent illusion, you're looking at a company facing severe structural Medicaid margin pressures.
Right, and they have planned state exits coming up.
Yeah, so the smart money just immediately dumped it. They didn't even wait for the earnings call to hear management's spin. They just liquidated.
Just ruthless. Okay, let's look at a key reversal in the other direction. Lucid Group, ticker LCID.
This was wild.
Yeah. So Tuesday, this thing craters 16% because of EV bankruptcy rumors. Today, it stages this massive 29% surge.
Right, a massive short squeeze. And the mechanics here were triggered entirely by management actually stepping up.
Yeah, they didn't just issue some vague PR. They went aggressively on the record, called the rumors entirely false, and confirmed the liquidity runway goes deep into 2027.
Which is exactly what you need to trigger a squeeze. Because, the short sellers who piled in yesterday assuming bankruptcy, they were suddenly trapped.
Right. If you're short and the company proves they aren't going bankrupt, you have to rush for the exit and buy back the stock to cover your position.
And when everyone rushes that one tiny exit door at the same time, They just trample each other. They have to pay whatever exorbitant price the current shareholders are asking for, which is why it exploded 29%.
It's just mechanical rocket fuel. But look, the most consequential move of the day, the one that really resets an entire sector, was PayPal, ticker PYPL.
Oh, absolutely. This was a structural reset for the whole payment space.
Yeah, I mean, it surged 17.2% to close at $55.52. And the volume was staggering, 89.3 million shares traded today.
And that's all on the back of that bombshell $53 billion joint buyout bid from Stripe and Advent International.
Right, they put a $60.50 per share bid on the table. So why does this private equity bid change the structural floor for every other digital payment stock?
Because the public market had been compressing PayPal's valuation down to these ridiculously low single-digit PE multiples. Everyone thought the growth story was dead.
Right, the sentiment was terrible.
Yeah, but when smart, deep-pocketed private equity like Advent puts $53 billion on the line at $60.50 a share, they're definitively telling the street that public markets have mispriced the asset.
Right. If they're willing to pay $60, anyone holding shares at $50 realizes they'd be insane to sell. The supply of cheap shares just instantly evaporates.
Exactly. It forces analysts to reevaluate every beaten-down payment processor. The days of buying these things at single-digit multiples ended the second that Reuters headline dropped.
Which brings us to the most important part of this deep dive. What does all this mean for you, trading tomorrow's open on Thursday, July 16th?
Well, tomorrow morning is packed. We've got June retail sales at 8:30 a.m. Eastern, and then obviously we have those massive TSMC and Netflix earnings reports dropping.
So what's the statistical playbook here?
The main takeaway is, do not blindly chase morning gap-ups tomorrow. Today was a rotational low-conviction chop session.
Yeah, and historically, coming out of this specific type of thin tape, the probability of momentum carrying over into day two is only, what, 35 to 40%?
Exactly. The odds just aren't there to buy the open. Especially when you look at the S&P 500, we have a massive gamma wall sitting right at 7,600.
Yeah, market makers have huge options positions parked there. It's just an incredibly thick ceiling of overhead resistance.
It is. But the downside level is actually much more critical for risk management tomorrow.
Yeah.
You have to watch support at 7,550.
7,550. Okay, what happens if we break that?
If we drop below 7,550, the leverage in the options market flips. Dealers will be mechanically forced to short hedge their futures to protect their books.
Wow.
And that automated selling pressure could easily bypass human decision-making, triggering a really rapid slide straight down to the 7,500 level.
Right. So to translate that institutional plumbing into actionable steps for you, you need to stick to companies with predictable, high-quality cash flows.
Absolutely.
And if you are heavily allocated into high-beta physical semiconductors, strongly consider hedging that exposure before the TSMC numbers come out. Keep some powder dry.
But, there are a couple specific day two plays to watch.
Yeah, keep an eye on PayPal. It closed at $55.52, which is still roughly a 10% discount to that $60.50 buyout bid. If it holds $54 at the open, watch for a volume breakout as M&A arbitrageurs try to force it toward that $60 peg.
Then Elevance Health is the other key day to watch.
Right, after that 10% collapse today.
Yeah, because sector heavyweight UnitedHealth reports tomorrow morning. If they issue stable forward guidance, Elevance could see a violent mean reversion bounce as the market realizes today's sell-off was an overreaction to an isolated accounting issue.
So definitely keep Elevance and PayPal on your dual monitors at the opening bell. But before we wrap up, I want to leave you with one final thought experiment that really ties this whole macro tug-of-war together.
Yeah, the real test of this market.
Exactly. Because today, the stock market threw a party over a deflationary victory. But that victory was entirely subsidized by the cheap energy prices we had back in June.
Right.
But out in the real world right now, U.S. naval blockades and active military strikes are aggressively driving real-time crude oil back toward $85 a barrel. So the question you need to ask yourself tonight before you place any trades tomorrow is this. What exactly happens to a stock market that is currently priced for absolute economic perfection when July's energy bill finally comes due?